Everyone. In this video, we are going to learn about types of bonds. We have already studied about bonds. Bond is a fixed income instrument that represents a loan made by the investor to a borrower. Here, borrowers are the company or government. Investors in bonds are debt holders or creditors. There are different types of bonds. In this video, let's learn about these different types of bonds. First one, plain vanilla bonds. A plain vanilla bond is a bond without any unusual features. It is one of the simplest forms of bond with a fixed coupon and a defined maturity and is usually issued and redeemed at a face value. It is also known as straight bond or a bullet bond. Plain vanilla bond describes the simplest form of an asset or financial instrument. It gives the holder certainty about his investment as there is no element of surprise exists in case of plain vanilla. It gives the holder the benefit of easy valuation, less volatility risk and high liquidity. Zero coupon bond. A zero coupon bond is a type of bond where there are no coupon payments made. It is not that there is no yield. The zero coupon bonds are issued at a price lower than the face value and then pay the face value on maturity. The difference will be the yield on the investors. These are also called as discount bonds or deep discount bonds if they are for longer tenor. Here coupon rate is a return on investment in case of bonds. Under zero coupon bond, this return will not be there. Instead, the investor will get large amount of discount on the face value of the bond. On the maturity, the investor will receive the face value of the investment. This type of bond is suitable for people who require funds at the specified period of time in the future, like for children's education, retirement or planned tour, etc. Deferred coupon bonds. This type of bond is a blend of coupon bearing bond and a zero coupon bond. These bonds do not pay any coupon in the initial years and thereafter pay higher coupon to compensate for no coupon in the initial years. Such bonds are issued by corporates whose business model has gestation period before the actual revenue starts. Example of a company which may issue such type of bond include construction companies. Since interest is not paid on these bonds in the initial years, these bonds are suitable for long-term investors who seek an alternative to savings account. These bonds benefit the company since they don't have to pay coupon amount, which can be used by the company for some other purposes. Participatory bonds. A participatory bond is a bond whereby the issuer promises a fixed rate but the coupon cash flow may increase if the profit or income levels of the company rise to a pre-specified level and may reduce when the income falls below a pre-specified level. Thereby, the investor participates in the return enjoyed based on the company's revenue or income. Here the bond participates in the profits of the company. If the profit is high, the bondholder gets additional income. It is similar to income bond or preferred stocks. Extendable bonds. Extendable bonds are the bonds that allow the holder to enjoy the right to extend the maturity if required. The holder has an additional benefit in this case because if the rate of interest in the market reduces, the holder may choose to extend the tenor and enjoy the higher rate of interest in terms of coupon payment. For the benefit, the holder may enjoy the coupon rates that are usually lower than a plain vanilla bond. Here in case of bond, maturity date is fixed, but extendable bond gives the holder an opportunity to change the maturity date. Usually, investors purchase these bonds to take advantage of period of declining interest rates without assuming the risk involved with long-term bonds. Convertible bonds. Convertible bonds are special variety of bonds which have an inbuilt feature of being converted to equity shares at a specified time at a preset conversion price. These are attractive to those investors who prefer to wait till maturity period to conclude. They are usually issued by the companies who have high growth potential but are low on capital. When the maturity period ends, these companies can be expected to have high priced shares, making the return on investment substantial. Step up bonds. These are the bonds where the coupon usually steps up after a certain period. They may also be designed to step up not once but in a series too. Such bonds are usually issued by companies where revenues or profits are expected to grow in a phased manner. These are also called as dual coupon or multiple coupon bonds. With each step up, the holders are paid high rate of interest. Since there is less risk of losing out on higher market rates, step ups have less price volatility or price fluctuation. Foreign currency convertible bonds. Foreign currency convertible bond is a special type of bond issued in a currency other than the home currency. In other words, companies issue foreign currency convertible bonds to raise money in foreign currency. Foreign currency convertible bonds offer dual advantage of debt and equity to the investors. They have the guaranteed return in the form of coupon. They also get the advantage of converting it into equity and take the benefit of price rise. Exchangeable bonds. These bonds are similar to convertible bonds but differ in one aspect, that they can be exchanged for equity shares but not of the issuer. These can be exchanged for equity shares of another company which the issuer may have stakeholding. In case of convertible bond, the borrower can convert the bond to equity of issuer, but under exchangeable bond, he can convert it into equity of another company. These bonds provide inflation protection to investor to some extent because they are traded like bonds when share price is far below the exchange price, but traded like stocks when the share price is above the exchange price. Callable bonds. Bonds are issued with a specific feature where the issuer has the right to call back the bonds at a pre-agreed price and a prefixed date are called as callable bonds. Since these bonds allow the benefit to the issuer to repay off the liability before maturity, these bonds usually offer a coupon rate higher than normal straight coupon bearing bond. This bond is more useful to the company since it allows the company to pay investor off early if it is in the company's best interest to do so. To compensate the investor, the company pay higher interest. It is beneficial to the investors. Puttable bonds. Bonds that are issued with a specific feature where the bondholder has the right to return back the bonds at a prefixed date before maturity are called puttable bonds. Since these bonds allow benefit to the bondholder to ask for the principal repayment before maturity, these bonds usually offer a coupon rate lower than the normal straight coupon bearing bonds. The benefit of puttable bond is that if the interest rate rises after the investment date, reducing the bond value, the investor can recover some or all of this loss by forcing the issuer to redeem the bond at a par value. These are the different types of bonds. Thank you.